but let's welcome in Karthik Kumar, fund manager at Axis Mutual Fund, who's with us as well. Karthik, good morning. Great to have you with us here on the program. Thank you for your time. So, what's the broad makeup at the Kotak team? I mean, is it one of risk aversion? Is it one of hunting for opportunities and looking at what to buy, whether it makes sense, that makes sense, or I mean, just the mental makeup right now?
So effectively, what we are seeing right now in terms of style, if I were to break it down in the markets, is that lower risk and value in general is holding up well. And even within value, if you were to kind of dissect it down, it's low value is not getting, like cheaper stocks are not necessarily getting rewarded, but costlier stocks are getting penalized in the markets. And the other way to look at it is, as you mentioned briefly before as well, which is higher growth stocks. And so growth stocks and momentum stocks are taking the hit as well during the course of the correction over the last couple of weeks. So that's what we are seeing from a style perspective in the markets.
Karthik, right now, are you fully deployed, or is there some cash on the side? And what's the broader strategy that you're adopting, given that we're in really choppy waters, too much news flow, there's a budget coming up, and a fair amount of price damage has already happened in large parts of the market?
That's much more specific to schemes and the kind of strategies we are running. So I think that would have to be taken up at a scheme level or at a strategy level. But in my case, I'm still running the portfolio largely deployed. Obviously there are changes in positioning, and we kind of constantly evaluate to see which place is the best to stay in, given the nature of these markets. But as far as I'm concerned, I'm largely deployed.
Which is what I'm asking. The broader strategy framework right now, in terms of the models that you're following, what exactly are you doing in a market like this, and what's the advice?
So in terms of where we are seeing earnings upgrades we are seeing earnings upgrades in pharma. We are seeing earnings upgrades in some of the selective discretionary space. And we are still seeing earnings upgrades in some of the select industrials names as well. So in terms of our overweights, we are much more aligned towards that. Whereas large part of the earnings downgrades is where we are seeing in selective consumer staple names, and the metals and commodity names in general continue to see pressure as well. So that's how I'm positioned from a sector perspective, where I'm overweight healthcare and selective consumer discretionary place, whereas I'm underweight energy, commodities in general, and staples as well.
All right. Hi, Karthik. Good morning and good to see you. And Karthik, what about consumption? You know, I recall we chatted about this in the past, and I think you were hinting that maybe it's time to start nibbling in. How are you all placed on the consumption theme, and what do you like out there, staples or discretionary?
Still prefer discretionary over staples. That's been the case for some time now, and I'd still stick to that. Within discretionary, extremely selective as well. At least in my case, we have exposure to two-wheeler, some of the two-wheeler names, some auto ancillaries, selective consumer retail exposure place, discretionary retail exposure place. That's where our exposure is. And on the staple side, it's extremely selective. Less of the benchmark heavyweight names, and some of the less heavyweight names from a sector perspective. So it's more bottom up from a staples perspective, but in general, still prefer discretionary over staples.
Something you said right at the top, Karthik, do you think the market style has changed and it will stay changed through 2025, that high PE doesn't get rewarded, so no point chasing the previous winners? And so in that sense, it's an important point. Do you think that has already happened and it'll stay that way now for the foreseeable future? What's the sense?
I think it's too short. I mean, we've seen this over the last 10 days, and I think it's too short a time period to kind of conclude one way or the other. Because what we are seeing is in stocks that are reasonable, that have higher valuation but have delivered numbers, those stocks have bounced back strongly as well. So I think things will recalibrate post earnings, and where there is chance of earnings downgrades, to take a step back, if the earnings expectations is high and there is a remote chance of earnings downgrades, and those stocks and those sectors I think are more likely to be under pressure, is my guess. But we still have to see at the end of the earnings season to see how it pans out. While this is in general, high growth and high momentum stocks have been kind of laggards or have been hurt over the last 10-15 days. But I think the market should start differentiating even within that group to kind of treat better some of those names that continue to deliver on their numbers.
Okay, got that. Karthik, final sense, we've spoken about what you like and where you're deploying. Where would you be taking profits from? I mean, for instance, in the EMS space, we saw that this week because valuations are so elevated. The slightest hint of a miss or, the slightest commentary going off track, and there was a big correction that crept in, but then there's buying also. So like that, which are the pockets where you think it's kind of done for now and it's time to take some money off the table?
Some of the areas where we've kind of reduced our exposure to over the last couple of months, to look at your question the other way, is some of the industrial names, some of the cap good names, and utility plays as well, where I've taken some weight of these sectors.
Okay, all right, Karthik, I wanted to ask you about cement. We have gone through this phase. I'm looking at the leading indicators, whether I'm looking at cement, steel, credit card consumption, everything for January actually has not grown big time on a year-on-year basis at least. And now we're hopeful that we'll see some kind of action coming in the budget or from the government itself, as well as RBI could loosen things a little bit. If that's the case, the economy will revive. And some of these cement companies have not done much. What do you like from there? We had the leader yesterday, Ultratech Cement, extremely good set of numbers. How are you all placed on cement?
Personally, I still continue to remain underweight the entire commodity space. While you're right that if the government were to be proactive, both from a fiscal perspective as well as from a monetary perspective, RBI, then we might see a fillip there. But there can be other areas that we can evaluate in that scenario as well. And as of now, in general, the earnings environment, notwithstanding what you mentioned with respect to one particular company, still remains largely tepid in that space. So we'll still like to play all the themes that you mentioned through other sectors as it stands today. But if things do materially change and we start to see a pickup in underlying numbers, then happy to change my stance.
Okay. All right, Karthik, we'll leave it on that note. Thank you very much for joining in, and you have a good day today. Well, with that, thank you very much. With that,